Good morning. We are going to be recording our seminar today, so during the presentation, everyone is going to be muted. So currently, you should all be muted. We would like to encourage you to use the chat as the seminar is going on. If you have any questions, we will have time at the end for a Q&A session. So we will be monitoring the chat so that we can answer your questions at the end.
Well, thank you, Amanda. So my name's Mike Swenson. I'm the president of the MFC Group. And what we're doing today is we want to bring together a topic. I actually was just in a meeting about an hour ago, and on top of mind for many customers is how do I get parts? What's going on with supply chain? It's unbelievably disruptive to our company and my job. Dennis is going to try to give us some insight into what's going on, and I truly appreciate Dennis, you stepping in today and doing this. So we're doing this as a service to our business partners. We have distributors on the phone, companies we represent, as well as customers. And I know you'd love a active Q&A at the end, right, Dennis? I've seen you work. He's very willing to take questions and would love to get feedback on that. So I want to thank you, Dennis, again for joining us for the FasTech seminar on the future of the tech market. Dennis is with a company called Edgewater Research, and he's a senior research analyst. We're excited. I've seen him speak at the ECIA, Electronic Components Industry Association, as well as the Electronics Representative Association. High-ranked speaker, gave great insight. So we are very excited to have him today. And again, I just want to thank you, Dennis. One of the things that I've talked to you about this in our last discussion is Dennis is real. He's talking to people every day about what's going on with the market. So I find him to be very up to date with his perspective. We're not looking in the rearview mirror a year trying to figure out where we're going. He's very up to date with and well versed with what the current market doing. So with that, I'm going to turn it over to you, Dennis. And again, we're happy to sponsor this on behalf of the MFC Group. And again, thank you.
Thank you, Mike. Thank you for the kind introduction, and everybody welcome. Hard to believe it's already the middle of December and we're staring at 2023. As we get started, as Mike mentioned, just want to walk through a quick agenda for what I hope to cover today. So to start, just an introduction of who we are at Edgewater and what we do. 2, we'll look at the disruption that we've all experienced over the last several years. 3, we'll focus on the supply side of our business. We'll look at it in the rearview mirror, but as Mike said, more importantly, what that means going forward. Then we'll switch to the demand side, and then we'll conclude with our outlook for next year. As Mike mentioned, please feel free to use the chat function and reach out. My goal is to talk for 30 minutes and hopefully leave us 15 to 20 minutes for Q&A at the end. So just to start
Dennis,
with a little... Yes.
Could you share your screen, please?
Oh, I'm sorry.
That's all right.
That would help. There we go. That should help.
There,
So,
we can see that. Thank you.
perfect. Thank you. Sorry about that. So just to start, who is Edgewater? We're an independent research company. We specialize in technology, internet or digital research, and then consumer and e-commerce. So the way we view the marketplace, or from our research vantage point, we're ultimately trying to look from component level work all the way through to the end consumer, at least on a B2C side. And then we do also a lot of work on the B2B space as well. We work with, from a customer standpoint, some of your largest money managers in the world. And these are the people who are ultimately investing in the technologies that are here today, but also more importantly, will be here tomorrow. From an insights perspective, we do provide insights to our industry related customers through our fundamental research process, which I'll talk about on the next slide. And then we've been at this for a while. Our reputation dates back more than 2 decades, over 3 different companies. On our technology or our component side, we have 50 years of combined experience doing research on the industry. So we've been at it for a while. So why Edgewater? as I mentioned, in our fundamental research process, we're deeply connected in the industry. So literally, I spend my day on Zoom, phone, Teams, you name it, trade shows, interacting with people across the supply chain, from really sand all the way through to the foundries, and then ultimately ending up with your distributors, EMS providers, and even purchasing on some of the largest OEMs. So we try to take a holistic view on the supply chain. Yeah, I mentioned we are a trusted resource for the investment community, both in the public and private marketplace. So these are the people enabling the investments that are ultimately driving the technologies both today and tomorrow. And as I mentioned, we are an essential partner with all of the largest global technology companies, working with their teams to identify both procurement, but as well as work with them to shape their strategy as they look to invest in their businesses and what the future holds. So a little bit about me. I have over 10 years of experience in the industry covering semiconductors, memory, storage, distribution, with several firms. Over this time, I have developed an extensive network of people globally that provide insights into real-time trends within the marketplace. As Mike mentioned, a regular speaker at a number of industry events, and welcome the opportunity. And then how to engage with us, and I'll just cover this quickly. For those that are interested, please reach out to your counterpart at Mel Foster, but we have several models to engage should you find the topics that we cover today interesting and applicable to your business. So before we go forward, yeah, I do think it's important to look back at all of the events that have taken place over the last 2 to 3 years. And unfortunately, when we look back at the challenges that we've all faced, most of our minds and most of my conversations immediately go to COVID. And while COVID has obviously disrupted the business environment, disrupted all of our lives, there's more that's been impacting our industry than just COVID. So when we look geopolitically, going back to some of the trade disruptions between US and China, it's been in the press, it's been in the news in particular lately, but really what we're seeing right now from a supply chain, or what we experience from a supply chain, some of these seeds were actually set back in the 2019, 2020 period. So, as most of the people recall, the U.S. did place a ban on Huawei. They also banned SMIC, the third or fourth largest foundry in the marketplace. So a reaction to this ban from China was actually to block the U.S. from shipping trash to China. It's hard to believe, but one of our biggest exports to China is boxes that they are recycled and ultimately packaged. So when you think about that geopolitical disruptions and sowing the seeds for some of the freight and logistic challenges, going back a couple of years, we largely had an imbalance. Containers were ultimately stuck here in the U.S. as shippers were reluctant to float empty vessels back to China. So we had the seeds of that disruption really being laid in late 2020 as a result of China refusing to take our recyclables. As we move forward to the national disaster side, we faced all of these over various times, whether it was the AKM factory fire, the UMTC factory fire impacting crystals, impacting substrates, Micron's power outage. We had the winter storm in Texas, Renaissance fire, Panjit fire, WD and Kioxia this year with their contamination that basically knocked 10% of the global NAND flash production offline. At any given time, we have one of these. What has been unprecedented, which is a word I think we're probably all tired of hearing at this stage, is just the amount and ultimately the compounding of these natural disasters. We did have COVID outbreaks, and without minimizing the impact on humanity, the humanitarian crisis from it and the death and destruction from this disease, From purely a supply chain disruption, it obviously disrupted our life in the early part of 2021. We looked like we were clear sailing. The Delta variant emerged in Southeast Asia, that I would argue was probably more disruptive, especially on the assembly and test side of our business. We most recently, and I have not updated this slide to include the China lockdowns, which has also had a significant disruption across the supply chain. You know, it's easy to forget we had a little boat stuck in a river with the Suez Canal blockage. We've had several other port disruptions, COVID outbreaks around the ports, and then we've also had material shortages from foundry capacity to lead frames, packaging and test, water shortages, really a whole host of disruption over the last 2 years. And the thing that sticks out to me, you know, when we go through this environment, 2022, you know, will ultimately still be a record year for the semiconductor industry in whole, with both record sales and profits. So it's been remarkable to see this level of disruption. And really the only conclusion that we can draw has been that, you know, despite all of this disruption, the supply chain in the industry has shown a tremendous ability to adapt and pivot and be flexible through a very, very unprecedented time. Flipping over the supply chain in something that I'm sure, yeah, anyone, when you look at the suppliers or read through their quarterly financial calls, what's been common throughout the industry is the talk that inventory is lean. And as you look at this slide, I'm here to tell you unequivocally that that is false. We track in total $240 billion plus of inventory globally across the analog passive suppliers, compute suppliers. So think of that as your AMD, Intel, memory suppliers, the large distributors, ODMs, EMS, and then some of your key OEMs as well. So again, a fairly comprehensive look at the supply chain inventory levels. And what you can see from an inventory dollar basis in 3Q22 is that the inventory is still at record levels. So dollars were up 22% year over year versus 2021. And relative to the numbers in 2019, inventory is actually 61% higher than it was entering into the year that was disrupted from COVID. You know, the natural look at this chart at first glance is, of course, price has had an impact on the dollar of inventory held. In the other chart, we calculate the days of inventory, which is a financial equation, inventory divided by cost of goods sold times 91 days to give you a days. You know, the attempt of that is somewhat to smooth out price increases and the impact that that has, and really just look at it absent of the price increases. And what I could tell you with that is inventory dollars peaked in the second quarter of the year, and we actually saw some progress in 3Q as inventory was being worked through the supply chain. Where we saw the most pronounced sequential change in inventory was at the OEM level in particular, and that's largely being skewed by your PC OEMs, and we'll talk about some of the challenges in the PC market when we get to the demand side. So in general, not to say the golden screw phenomenon is very much real, although it's improving, but to say inventory is lean across the board, there is plenty of stuff, to use an overly technical term, in the marketplace right now. It might not be the right inventory. It might not be a complete bill of materials, but inventory is more than full in our view of the marketplace. As we shift to the next slide, yeah, I think this is an important and an interesting one to look at, and it's more of one, and I know it's busy, and please feel free to reach out to your point of contact at Mel Foster for the deck, because this slide is busy. But yeah, I'll ask just a rhetorical question. When we look at the industry, including memory and excluding memory, the compound annual growth rate between 2014 in 2019 was 4% with memory and 3% without memory. And as we look to what's happened in the COVID years, including the WSTS forecast, we're looking at double the growth rate, including memory, and almost 3 to 4 times the growth rate when you strip memory out of the marketplace. So just rhetorically, I would ask everyone in the audience, can you think in your business, with the exception of maybe electric vehicles, what market is growing 4 times what it was prior to COVID? And for the life of me, I can't find one. There are significant long-term structural demand growth in multiple markets in our industry, but not ones that are growing 4 times the growth rate. So again, going back to the previous slide, the only thing that we can surmise is that one part it's pricing, but the second part is inventory has built as we've all faced the supply chain disruptions. And then before shifting over to the demand side, just put this slide out to remind everyone when we go through the end market outlook, between the compute supply chain, the consumer, and then ultimately when you roll smartphone into the marketplace, that's still 50+% of the industry. So while I know probably most on this call do not deal with smartphone providers or the compute OEMs, it is important to realize the way that the compute suppliers go, the way that the consumer markets go, and then ultimately the way the smartphone market goes will have a significant impact on the availability across all the other markets. So, looking quickly, and you'll see this chart again, just looking at the forecast, but looking quickly, I do think it's important to just set, some level of this concept of cyclicality versus structural growth within the industry. And without going into numbers, as you can see, our forecast for 2023 is a down year. But what I would tell you is, despite next year being forecasted by Edgewater as a down year, that is really the cyclical correction or the inventory that's been built throughout the supply chain being worked through the system. And as you can see, the forecast going out into 2030, we firmly believe that we will be close to $1 trillion per year industry in 2030. So the structural growth drivers are still present and very much alive in our industry. We're just in a phase where we're balancing some level of the cyclicality in our business that has not left, nor has it changed versus other periods in history. So what's driving the cyclical growth in the marketplace? So, one, we had pricing, which I mentioned earlier, but for those concerned, and probably most on the call have lived through line down situations, escalated orders, all the pains that we've dealt with over the last 2 years. In this chart, I'm here to tell you capacity is coming, and capacity is coming in a significant manner in both 22, but as well as 2023. So this looks at capacity or capital spending for the entire industry across the compute supply chain. So again, that's CPU, GPU, memory, the foundry supply chain, but as well as the analog and passive and discrete marketplaces. And at first blush, when I looked at this, we had double-digit increases in terms of year-over-year growth in 2020, 2021, and then 2022 now has come back a little bit to earth. But what I would tell you, what's interesting to me, and when I first looked at this, is this obviously has to be driven by the compute and the foundry marketplace. We've all seen the headlines. Taiwan Semi in particular is spending very, very aggressively, in particular on leading node technologies. Intel as well is investing very, very heavily to build out their foundry business. So I looked at this and at face value said, all of these gains, in particular in 21 and 22, that has to be tied to compute and foundry. So I stripped that out and just looked at the analog and passive space. And on a year-over-year basis, the spending actually was more as a percentage growth basis. And this was a little shocking to me. in particular. And 23 has come back a bit as the market has moderated here in the second half of the year. But again, we're staring at a year that's a 60-ish% growth in this world in 2021, and again a 35 to 40% number in 2022. So the spending in the trailing edge technologies is also there. What I would say has ultimately limited that from probably being realized earlier in the year has been the supply chain crisis. It's an interesting dynamic, and it is a little bit of a chicken and an egg scenario where all of your leading analog suppliers are having issues getting equipment from either your front end or your back end. Your front end and back end equipment suppliers, your Applied Materials, your Teradynes, et cetera, of the world, they're having issues building their machines because they can't get chips from their component providers. But with that being said, capacity is coming. Texas Instruments is the supplier in particular that's leading the spending charge. They have a 300 millimeter fab that is ramping and being qualified as we speak with our Fab 2, that when it's fully equipped and fully utilized, provides an additional $6 billion in sales to them on a base of $18 billion. But they're also ramping LFab, the fab that they acquired from Micron, and then they're breaking ground in 2024, 2025 on another campus in Richardson. So in aggregate, Texas Instruments alone is bringing $18 billion of revenue capacity to the marketplace. And that excludes, of course, every other major supplier who's been spending well above their historical patterns. So again, I'll leave you with this in the trailing notes. Capacity is coming. And it is arriving as we speak and will continue to arrive next year, all at the time when industry growth is slowing cyclically. So shifting over to the demand side, as I mentioned, I'll cover the PC server and smartphone, quick, but this at the end of the day still sucks up a significant portion of our industry capacity. And as you can see in the chart, it's not pretty. So what we clearly saw through COVID in 2019, there was about 275 million PCs shipped. That jumped to 300 in 2020, and then ultimately 330 in 2021. The biggest challenge with this slide and these forecasts is the supply chain, led largely by Intel, the memory suppliers, and your major OEMs. They were forecasting 365 million units this year, and that number is going to come out to be somewhat closer to 285 million. So a significant shortfall of demand compounded with the supply chain crisis has led to a significant amount of order cuts in this marketplace. The demand outlook for PC is still challenged for next year, really in the 260 to 270 million range. So again, coming back to pre-pandemic levels. And all I would say for most on the call here, what I would take away is all of your key suppliers are shifting capacity to the industrial markets, to the automotive markets, to the general channel markets. So again, along with that capital spending, bringing new greenfield capacity online, we do have mix being shifted and arriving to the marketplace right now. Similar look from a server side, just to round out the compute space. While it clearly has not been as much of a pull-in here in the COVID years, if you look back to the sharp spike in 2018, a lot of that had to do with cloud and hyperscale growth. What we've been operating in is an environment where the cloud has been very robust. The enterprise or on-prem spend has been challenged for obvious reasons. We do think it's a downtick this year and kind of a similar number last year at the flat to 2% range from a unit basis. But what I would leave everybody is from an end demand standpoint in server, we do see more risk to this number than we do upside. And the risk is twofold. One, from a data center or hyperscaler stance. So the AWSs, the Microsofts, the Metas of the world, where we sit in the middle of December, their CapEx plans for next year have not been officially released to the supply chain. Early projections are low to mid-single, or I should say mid-single, 5, 6, 7% year-over-year growth. That's the lowest it's been in years. And then the enterprise projections right now are flat, but we all know what's going on from a macroeconomic. So again, we've got the number at 1% unit growth next year. Our bias with 15 days left is that number goes lower rather than higher. Switching quickly to the smartphone market, and again, I won't touch on a whole lot here. The important thing to note is 2022. So total smartphones on January 1 was forecasted to be about 1.5 billion, with 750 million of those being 5G. With the year almost over, we're looking at roughly 1.24 million and 615 million devices for this year. I do need to update the chart. The forecasts right now for next year are flat on a total unit basis, with probably a 700 million of 5G. So again, we're seeing an overall flattish stabilization market, with the biggest delta being the Chinese market, which has been largely shut down due to COVID protocols and limited demand seen coming, even if they ultimately remove those protocols and return to kind of life as normal, if you will. More importantly, I'm guessing for the people on the call, flipping to the automotive side. Automotive has been a very, very robust market for the industry, despite accounting for 10 to 12%. And what I would tell you is there's a couple of things that we find interesting here. First of all, looking at 2022 production numbers on a global basis, as you can see, they are effectively down single-digit range. So to put some numbers behind that, they're going to end up, call it 81-ish million units, down a couple of points from last year. The real interesting point is the forecast starting this year, we're closer to 85 or 86 million. So we've seen, a 6-7% decline to production forecasts as the years progressed. This year has been entirely driven by supply chain and component issues. So those issues are real. And I'll flip to the demand side for auto on the next slide here in the US. Those issues, though, are ultimately very, very real. But despite all of that, as an industry, the industry has grown in the mid 20%. So some of that is the transition to EV. Some of that has been the general electrification or content gains throughout the internal combustion engine vehicles. Some of it has been mixed, as all of us and consumers have been effectively placed on allocation. And then ultimately, some of that has been inventory built in the supply chain. Looking into next year from a global production standpoint, forecast where we sit right now, put that number in the 85-ish million range. What I would tell you is the supply chain crisis, in our view, is largely over for automotive from a component standpoint. Any supply chain crises in auto is largely self-inflicted in our belief, and we have heard instances where there may be a key component shortage or just a reluctancy to produce and or procure components at a higher level, which has driven some level of factory shutdowns. We feel good with that 85 million number range globally, assuming we end up the year we end next year in a somewhat similar economic environment to this year, which again hasn't been great by any stretch. Looking at sales here in the US for auto, so seasonally adjusted automotive run rate. So it's a monthly number based on what the seasonal sales numbers have been here in the US. There's a couple of interesting things. So again, going to a common theme, The forecast to start this year, we're very, very optimistic. In the supply chain and the auto OEMs, we're looking for that 16 to 17 million vehicles sold in the US. At the end of the day, and at the end of the year, we're going to end somewhere around 14 to maybe 14.5 million units. So a significant a significant downside to demand in 2022. But again, going back, we've seen content gains, we've seen mix driving a richer component environment than we did end demand. More importantly, where does this number go for next year? So our forecast for next year is really in that 16 to 16.5 million unit number, which admittedly is down from 90 days ago, where that number was closer to the 17, 18 million range. But what I would tell you is even at the 16 to 16.5 million, that forecast is for 20% unit growth going into next year. So the outlook for an automotive demand is strong. Where we've spent a good deal of time in the last, call it quarter, is running through kind of best and worst case scenarios as you think about planning your business into the automotive market. And I'll share a few of those with you. So with the base case of, 15 to 16 million, a certain percentage of that is kind of your floor demand. So that's your fleet vehicle sales, that's your rental fleets, government purchases. There were 375,000 vehicles that were, destroyed as a part of the hurricanes that rolled through Florida. There's a car accident that results, all of those scenarios. Our analysis would put that at 12 million units for next year. So the way we're thinking about it is if everything goes wrong, and that's from a macroeconomic standpoint, interest rate standpoint, the consumer struggles, probably the floor on demand is 12 million vehicles, which still can put the automotive market from a components side in the high single to maybe low double-digit growth environment. And if everything goes right, we see some relief with interest rates, supply chains are fixed, et cetera. That number probably gets to that 17, 18 million. So that's kind of the range that we're operating within in our forecasting for next year from an automotive standpoint. As we switch over to the industrial markets, as we all know, industrial from a component vendor is very hard to find hard data. So we just use total manufacturing in the US as a proxy or a base level for our forecasting or our review of the marketplace. And I do think this chart is somewhat telling. Historically, when I've given similar events, I've included transportation in the manufacturing, but what we've seen near term is really a divergence. So if I included transportation, this number would still be 10 or 12%. But as you can see, we're going into that low single digit range through the end of October in manufacturing X transportation. So what does this all mean for us at the component side or the distribution side? What does this mean for our business going forward? So what the key thing that I think to consider is there are markets that are driving significant content growth within the marketplace. One being automation, and that's being driven, twofold. I think one, we all know there's a significant labor shortage really across any industry. And as harsh as it is to say, what is the best way to eliminate a wage inflation, a worker shortage? It's to eliminate workers. We also see, just in terms of the cycles within your industrial companies, the companies that are skewed to automation, those tend to be late cycle industrial outperformers. So the automation business, we would put it is closer to a 6 to 8%. So, again, 2 to 3 points of market outperformance of that, 3 to 4% number. Likewise, the robotics is another area of interest and growth. And, in robotics, it is an interesting market, being the largest e-commerce company, Amazon. To give you a proxy for their robotics business, pre-COVID, they were building and deploying 25,000 robots per year. That number ballooned to 300,000 at the peak this year. And the forecast for next year are 150,000. So in a vacuum, cyclically, that number is obviously very, very challenging to look at, a potential for down 50%. But I do think it's important to realize, relative to where we were pre-pandemic, it's multiples of where we were before that. And what's going on with Amazon in particular as a customer, they are simply digesting their warehouse space. Through the pandemic, they pulled 10 years worth of warehouse and distribution center growth into a 3-year window. And now they ultimately need to grow in to that marketplace and then begin to wring some efficiencies from their own supply chain, which at the end of the day, I do think speaks very well. The robotics does speak very well to the opportunities within automation as well. Lastly, as a subsector from just the pure industrial marketplace, would tell you just general energy efficiency, which is it's a harder one to classify. But as we see factories push to be more efficient, whether it's due to green initiatives or simply cost cutting or OpEx driven actions in a rising energy cost environment, we do put energy efficient investments as a market that is growing 10 to 12%. So again, one of the leading market growths is the industrial customers do focus on driving more efficiencies through their factory. Other subsegments, just to give you a proxy of growth, medical, while it is a small market, it has gone through, some level of cyclicality as there was a massive push for ventilator growth. Then that rolled over and, ultimately we're into a more normalized environment. The unfortunate thing from a population standpoint is we're not getting any younger and we're certainly not getting any healthier. But what that means from a technology standpoint is it's a market that's going to grow high single digits for the next 5 to 6 years. So again, 8 to maybe even 10% low double digits. That's being driven by a whole host of different projects, from just the digitalization of the doctor's appointment to more at-home treatments, whether it's glucose monitors, whether it's home heart rate monitors, home EKG. There is a push to be more efficient and to bring more care to the consumer, which is good for ultimately the medical market. And then lastly, just to touch on the aerospace and defense marketplace, again, not making light of the humanitarian crisis in Ukraine, but that does provide a nice tailwind from a military standpoint in our business. When conflicts like this occur globally, it's impossible to scale production in the near term. So what we've seen in the supply chain is really a redeployment of assets, meaning the Stinger missiles or things like that are being pulled from the U.S. and other allies. Inventories or stockpiles and being deployed in the Ukraine. And then ultimately those stockpiles will need to be replenished. So, we do think there's a long tail on the military side. The aerospace side, the tail is more of commercial air flights returning to pre-pandemic levels, which we've seen, here in the U.S. and we're starting to see it globally. And the tail with that is more of the aftermarket with break fix across various systems in the industry. So again, while the market is clearly moderating, which I'm sure everybody on the call would attest, we do see reasons to be optimistic as we look at, 2023 and beyond, once we get beyond this cyclical correction. I'll cover this quickly. So, what we did here is we just pulled distribution inventory levels. So again, going back to that earlier chart on the supply chain, we pulled distribution inventory levels both on a days and a dollar level. So for distribution, dollars of inventory are 70% above where they were pre-COVID. So distribution is full. And we've seen, the days of inventory trying to normalize for pricing. They're also roughly 24-25% above previous peaks. So we do see a healthy to somewhat oversupplied distribution marketplace, which is we get into our forecast in two slides here. Distribution and ultimately EMS burning inventory is one of the main drivers of what we see as a cyclical correction next year. From a supply side, and by no means is this meant to be representative of every supplier, but trying to take a decent enough snapshot of where we sit from a pricing and lead time standpoint. We update this every quarter, so this is due for a refresh. But as you can see, and those that have been on or have seen this in the past from us, we've definitely moved much more to an environment where lead time is falling. And actually, if I refresh this right now on the fly, everybody's lead times are falling. What's been unique in this current environment, despite backlogs coming in, despite lead times falling, despite inventories being elevated, the pricing has remained benign to robust, depending on the category, the supplier. And what we'd ultimately attribute that to is the inflationary environment that we're operating in. Wage inflation is real. Materials inflation is still real. What is different this time through other cyclical corrections is the inflation picture that looks broadly more like the late 1970s as opposed to other corrections that we've dealt with in the industry. So to finish, just our forecast for next year and beyond, and what does this mean? So, we covered a lot here. Our number for next year is down 8% year over year for the industry. And how does this ultimately flow through in the quarters? What we do see is a tale of two halves here in the near term. We think the supply chain will continue to burn inventory throughout the June quarter, so the first half of the year. So we fully expect the first half of the year to really be a hole for the industry to dig out, with growth returning in the second half. As we move forward to 24, we think it's more of a flattening again as we try to find our footing for what demand is across really any end market before returning to growth in 2025. So again, the near-term outlook for us is a little bit more guarded than most industry prognosticators. But as I showed on one of the earlier slides, despite the cyclical pressures that we see near term in the business, we ultimately do think the market is healthy, the growth outlook is robust, and we do see the market being near $1 trillion industry when we exit this decade. So one more reminder on how to partner, and with that, I'll open it up to any questions.
Thank you, Dennis. That was a great presentation. We do have several questions in the chat, and if anyone else has a question, feel free to go ahead and add it, and I will read those out for Dennis. So our first question says, Intel, Global Foundries, Samsung Foundry, TI, and TSMC are building new fabs in the US. When will this supply be available to the market, and will that supply add to the inventory?
Yeah, so great question. They're all. I would have to go through, individually with each supplier to give you the exact impact in the U.S. So we saw President Biden was in Arizona, I think last week or the week prior, with the groundbreaking ceremony. TI is currently qualifying our Fab 2, which is $6 billion in revenue capacity. LFab starts next year, which is another $6 billion in capacity starting to come online. So, probably the easiest way to to look at it is the capacity is coming as we speak, and will continue to come, will continue to enter the market really through next year and probably into 2024. As we think about this longer term, and what it relates to inventory, if you take a step back and you just chart the industry growth or industry sales over a 50-year window, that line will largely look linear. So it's up and to the right. There's no doubt that, semiconductors in general have changed the way we live, and we don't see that changing. The way to think about the capacity, though, is a step function, right? So we always operate from a cyclical standpoint where we get into a period of tight supply. All suppliers, whether it's Intel, whether it's the foundries, whether it's TI, they ramp spending. The typical lag is 2 to 3 years between spending and actual production, which is what's playing now. And they ultimately overshoot it. And then we'll enter a period where we have to grow into it. And I think that's where we are now. And that's where we'll see the supply chain next year, in particular for the first half of the year, really burn inventory aggressively. And does set us up with a reasonable demand environment to begin shipping it more at the demand levels versus under shipping near term.
Thank you. Next question. As you mentioned, the EV market is experiencing explosive growth, especially for high power and voltage power semiconductors. MOSFET, IGBT, SiC remains sold out through 2023. Not true for consumer MOSFETs. This segment does not have clear breakouts in the semi data shown as it's lumped inside analog. Is anyone trying to break that out? What is long-term supply-demand imbalance due to EV?
Great question. So we spend a lot of time with it, and you're 100% right. Power MOSFET into the auto space is still 50 weeks where consumer is available. So there still is some disruption from a supply standpoint that's being rapidly addressed. So to give you some numbers behind it, between now and 2025, the fab capacity for analog, in particular power analog in a general sense, is expected to grow at a 35% CAGR over that window between 22 and 25. And in that same time, the most optimistic forecasts for analog and then ultimately power is probably a 14 or 15% CAGR. So with just those as a proxy or a benchmark, the capacity that's coming over the next 3 years is double the market growth rate. So, there could be some puts and takes in terms of, EV and managing that supply chain. Yeah, I'm very, very long-term positive on the demand outlook for the EV market. But I do think the industry has to go through some level of consolidation. Obviously, Tesla's the leader. There have been many other entrants into the marketplace. It is a premium vehicle, and we're entering just a tougher environment to gain credit. So I do think there's some puts and takes, but I'll still hold to a forecast that I've done earlier. I think the market's going to be 2.5-3 million vehicles this year. Exiting 2035, can it be 50 to 55 million? Absolutely. And I think there will be ample capacity to meet that.
Very good. Dennis, in your opinion, how much of the distribution buildup in inventories is due to a change in mentality of just in time versus just in case? Or is it more due to slow demand, push outs, cancellations, etc., from end customers?
Great question. So early in the disruption, there were a lot of articles, Harvard Business Review, et cetera, saying the supply chain would fundamentally change to a just-in-case approach versus just-in-time. And, I think what we've seen is the push-outs and the cancellations have accelerated here in the end of at the end, or in the end of this year. It is just flat out expensive to hold inventory. So, the inventory levels where they are currently present really two problems from a financial side. The first being a working capital issue, and some of this is tied to key components. Some of this is tied to the cost of money and everything else. But at the core of distribution, it's money in, money out, product in, product out. So what we saw early in the pandemic was if we need if we're building 100 widgets, give us 120 of every single piece of material on the BOM. And in some cases, we had 75 percent of the micros show up, and we had 120 of the capacitors. So we're in an environment now where the CapEx side is, we have plenty of conversations at all the major distributors globally that they're facing decisions on how much warehouse do they need to lease, buy, build out, et cetera, because they are flat out full. So, going forward into a relatively uncertain demand environment near term, our bias is we'll get behind this and people will have short memory and we'll move to, much more of the way it was with a just-in-time approach to inventory.
That's great. Dennis, what's your experience or opinion on published versus real lead times? We just did a quote with a business partner, and 75% of the items on the BOM came back with lead time over 150 days. Upon further analysis, many of these parts were widely available in distributor inventory. We understand that there are still some golden screw items that are still under allocation, but for the rest, passives, memory, some discretes, etc., why have suppliers been reluctant to adjust their published lead times?
Sure, great question. So, quickly at the lead time. So right now where we sit, there's 3 lead times in the marketplace. There's published lead times. There's the lead time that's provided via delivery date when you place an order, and then there's the lead time when they ultimately deliver. And to give you some framework, and again, each product family, each supplier is different, so this is just meant to be general. General published lead times, in particular for the semi space, are still 50-ish, 52 weeks. Delivery lead times when the order placed is probably closer to 35, and then actual arrival lead times, I would put it closer to 20 to 26. So that's kind of the environment that we're operating in. The why behind it is to us very, very simply that the suppliers are trying to navigate a soft landing in the current better supply availability. So if you think of this in a vacuum, if you're a distributor that has a target of turning your inventory once a year and every lead time is 52 weeks, you have to provide a supplier with 52 weeks worth of orders, and then everything's scheduled out and delivered. If that supplier comes and cuts their lead time to 25 weeks, your distributor will immediately cut their backlog to 25 weeks. So, there's one side of what I would say is just the non-cancelable programs that are out there that are disrupting it a little bit. But the other has been suppliers trying to navigate a soft landing. So hopefully, the first quarter could be down 5 or 6% quarter over quarter in a correction environment versus down 15.
Thank you. That's helpful. For automotive outlook, you showed 2023 up versus 2022, but not yet reaching historical normal levels. What are your thoughts on 2024 and beyond?
Yeah, so that's a great question, and we at this stage we don't have an official forecast for 2024 and beyond for the total SAAR in the U.S. But when we look back at that SAAR number in the peak in the U.S., I think the highest it ever reached on a monthly basis was, I want to say 18.5, 19 million vehicles. And, our view is there's really no reason for it to go back to that level. We think there's a certain level, call it that 12 million floor. To put an idea of what we think is kind of a realistic, number, you've got a 12 million floor, you've got, call it 1 million units in the US that, I'll half jokingly call it the midlife crisis. Somebody needs a third car, probably a Porsche or something like that. They're not really worried about financing, et cetera. So that puts you at 13 million that are core. And then there's, that 4 to 5 million that's a decision being made and we've all probably been in that environment where you're driving a car with 120,000 miles, you've had nothing besides oil change, tire rotation, et cetera, and you bring it in, and that same type of service appointment includes brakes, struts, just normal wear and tear, and you're staring at a $4,000 or $5,000 bill for the service. You have to make that decision of kind of, do you buy new or do you put it off? And that's, that 4 million at risk. That's what I would describe it, the 4 million at risk. So when you extrapolate, where does that 16 and a half, maybe even 17 go? I think that's puts and takes around that number of, what do we see from a macro environment where that swing number, do you have more people who pull the trigger because interest rates are favorable, there are more deals, et cetera. But, I think that 16 and a half, maybe 17 on the high end, plus or minus, a point or two around, that's probably a reasonable way to look at it going forward.
Thank you. You showed distribution inventory going up. Is there any data on the mix of that inventory?
Unfortunately, we don't have great data to show the mix. So, I couldn't break that down on any further. Sorry about that.
Thank you. And our last question for now is, it would be good to see the updated lead times and pricing environment chart for 4Q22. We just had a semi-supplier reduce lead times in half, but increase prices across the board. Sorry, comment, not question.
Yeah, no, appreciate that. And I would say, by all means, reach out to your point of contact at Mel Foster. They've been a great partner with Edgewater. They'd be able to provide it when we update it. Or as I mentioned, the presentation has my contact information. If you're, interested in engaging with us directly, would be more than happy to have a conversation over the next couple weeks.
Thank you. Do we have any other questions? Oh, we have one more. Does the mix in automotive combustion versus EV change the overall IC available outlook?
So when we look at next year, for our outlook next year, we do have a mix shift in that total number. So EVs globally, I think, as I mentioned, there'll be about 2.5 to 3 million. We'd put that number about 4.5 million next year. So we do see significant outperformance from EV relative to the internal combustion on a percentage growth basis. Right now in the near term, 4.5 million vehicles call it 85 million base. It isn't enough near term to dramatically alter our outlook for a rebalance next year.
Thank you. So as of now, that is all the questions we have. So thank you so much for your time today, Dennis, and for sharing such a great presentation with us. We will, and thank you everyone for joining us and participating. We will be sharing our recording of the session with everyone who's registered within the next few days. If anyone else has any further thoughts, then feel free to put them in the chat. And otherwise, we will wrap it up for today. I think that's all. So thank you so much.
Thank you very much for the time. It was a pleasure, and have a great holiday season for everyone.
Thank you. You too.